Stop. Before you skip past this, understand that what you are about to hear could be the single most important financial decision you make in the next decade. Every single day that you wait, the IRS is quietly positioning itself to take a larger and larger cut of the retirement savings you spent your entire working life building. This is not a scare tactic, this is math. Cold, brutal, unavoidable math. The retirees who figure this out early walk away keeping tens of thousands more of their own money. The ones who ignore it hand that money straight to the government without ever realizing they had a choice. You have a choice right now. But here's the brutal truth that nobody in the financial industry is rushing to tell you. That choice has an expiration date, and it is coming faster than you think. The window we are talking about is real, it is legal, and it is sitting right in front of you. But it will not stay open. Miss it, and you do not get a second chance. So, if you've ever worked hard, saved diligently, and told yourself you deserve to keep what you earned, then the next few minutes are going to change the way you think about your retirement forever. Now, before we go deeper, let's make sure we're all on the same page about how these two types of accounts actually work. Because the difference is fundamental. A traditional IRA or 401k is funded with pre-tax dollars. That means you get a tax break when you put the money in, but when you pull it out in retirement, every dollar is taxed as ordinary income. The government has been patient, but they will eventually collect. A Roth IRA works the opposite way. You contribute money that has already been taxed, so there is no upfront deduction. But here is where it gets powerful. That money grows completely tax-free, and when you withdraw it in retirement, you owe absolutely nothing in taxes. Even better, Roth accounts have no required minimum distributions, and you are never forced to take money out. That makes them one of the most powerful tools available for long-term wealth preservation and passing wealth on to the next generation. Listen closely, because what I'm about to tell you could be the single most important financial decision of your retirement, and most people completely blow it. Right now, sitting between the day you retire and the moment your required minimum distributions kick in, there exists a narrow, time-sensitive window where your taxable income temporarily drops. This is not a coincidence. This is your opportunity. The years before Social Security activates, before RMDs force money out of your traditional accounts whether you want it or not, before Medicare surcharges start clawing back your benefits. These years are your golden window to convert traditional IRA money into a Roth at the lowest tax rates you will likely ever see again in your retirement lifetime. Miss this window, and you may spend the next 2 decades watching the IRS take a bigger and bigger bite out of every dollar you worked 40 years to save. Act on it strategically, and you can fundamentally reshape your entire tax future. The clock is already running. Now that you understand why tax brackets matter so much in retirement, let's define the Roth conversion window precisely, because timing is everything with this strategy. The window typically opens the moment you stop working. The day you leave your job, your earned income disappears, and suddenly your taxable income drops dramatically. But here's the critical part. This window exists before you are required to take Social Security, before pension income begins flowing, and before required minimum distributions kick in at age 73. This gap period can last anywhere from a few years to nearly a decade, depending on when you retire and when you activate those income sources. During this time, your taxable income may be lower than it has been since early in your career. That is not a problem to solve. That is an opportunity to seize. This brief window represents one of the only moments in your financial life where you can move significant money from a taxable account into a completely tax-free environment at historically favorable rates. Let me make this real with a simple example. Imagine a married couple, both age 62, who just retired. They have no earned income, and they have decided to delay Social Security until age 67 to maximize their monthly benefit. For those 5 years, their taxable income is remarkably low. Now, the top of the 12% federal tax bracket for married filing jointly sits around $89,000. If this couple has roughly $40,000 in living expenses covered by savings, they have significant room to convert traditional IRA funds before hitting a higher bracket. By converting around $40,000 to $50,000 each year during this 5-year window, they could shift hundreds of thousands of dollars into a Roth IRA at just 12%. Compare that to paying 22 or 24% later when Social Security and required minimum distributions stack up. The lifetime tax savings could easily reach $50,000 or more. That window is genuinely powerful. Now here's the critical part. This window does not stay open forever. In fact, it can close faster than most people expect. Once Social Security begins, up to 85% of those benefits become taxable income. That alone can push your bracket higher than you might anticipate. Then at age 73, the IRS steps in with required minimum distributions. These are forced withdrawals from your traditional accounts, and they happen whether you need the money or not. You have no choice. That income gets added to everything else you are already receiving. Now imagine layering a Roth conversion on top of Social Security income and required minimum distributions simultaneously. Suddenly you are no longer in the 12% bracket. You could easily find yourself in the 22, 24, or even 32% bracket. At that point, converting becomes far less efficient. In some cases, it can actually work against you. The math simply stops making sense once these income sources stack together. Now let's talk about something that catches many retirees completely off guard, the RMD time bomb. For decades, people diligently contribute to their traditional IRA or 401k, watching that balance grow, feeling proud of their discipline. But here's what most don't realize. The IRS has a claim on every single dollar sitting in those accounts, and at age 73, they will force you to start withdrawing whether you need the money or not. These forced withdrawals are called required minimum distributions, and the math can be brutal. If you've accumulated $500,000, $1 million, or even $2 million in traditional retirement accounts, your RMDs could push you into tax brackets you never anticipated. The larger your balance, the larger the withdrawal, and the larger the tax bill. This is precisely why the Roth conversion window is so powerful. By strategically converting portions of your traditional accounts during those low-income years, you're essentially diffusing this time bomb before it ever detonates. Here is something that catches most retirees completely off guard. Up to 85% of your Social Security benefits can become taxable income depending on your combined income level. This is not a rare edge case, it happens to millions of retirees every single year. Here is where it gets especially painful. When your required minimum distributions kick in at age 73, those forced withdrawals count as income. That additional income can push you past the thresholds that trigger Social Security taxation, creating what experts call a stealth tax rate. Your effective tax rate ends up being significantly higher than whatever bracket you appear to be in on paper. This is exactly why the Roth conversion window matters so much. By converting portions of your traditional IRA before Social Security begins, you shrink your future required minimum distributions. Smaller distributions mean lower combined income in retirement, which means more of your Social Security benefits stay completely tax-free. That is a compounding advantage that builds quietly but powerfully over time. There's another hidden cost that catches retirees completely off guard, and it goes by the name IRMAA, which stands for Income-Related Monthly Adjustment Amount. Medicare Part B and Part D premiums do not stay flat for everyone. For higher income retirees, these premiums can increase dramatically, and here is the part that stings the most. Medicare bases these surcharges on your income from 2 years prior. So if a large required minimum distribution spikes your income in a given year, you could find yourself paying significantly higher Medicare premiums 2 years later, adding hundreds or even thousands of dollars annually to your healthcare costs. This is where the Roth conversion window becomes even more valuable. By strategically reducing your traditional IRA balance during those low-income years before required minimum distributions begin, you shrink the future withdrawals that would otherwise trigger these surcharges. Smaller required minimum distributions mean lower reported income, which means lower Medicare premiums and more money staying right where it belongs, in your pocket. Now that you understand why the window matters, let's talk about how to calculate exactly how much to convert each year. The goal is straightforward: fill up your lower tax brackets without crossing into higher ones. Think of each tax bracket like a container. You want to pour in as much converted income as possible before that container overflows into more expensive territory. Here is how the math works in practice. Suppose a married couple filing jointly has $40,000 in taxable income during their conversion window. For the current tax year, the top of the 12% bracket for married filing jointly sits at $89,000. Simply subtract your current taxable income from that bracket ceiling. $40,000 from $89,000 leaves $49,000 of conversion space remaining. That means they could convert up to $49,000 that year, and every dollar stays taxed at 12% or below. This bracket filling strategy is the core mechanic of every effective Roth conversion plan. Now you might be thinking, why would I voluntarily pay taxes today when I can delay them? That feeling is completely understandable. Writing a check to the IRS never feels good. But here's the key reframe that changes everything. The question is never whether you will pay taxes on your traditional IRA money. That money will be taxed. The only real question is when and at what rate. Paying 12% now versus 22 or 24% later is not a matter of opinion. It is straightforward math. The numbers simply work in your favor when you act during the window. Beyond the math, Roth accounts offer something traditional accounts never can: flexibility. You are not forced to withdraw on anyone else's schedule. There are no required minimum distributions pushing you into higher brackets. And if leaving a legacy matters to you, Roth accounts are exceptional inheritance tools. Your heirs receive that money completely tax-free, making it one of the most powerful gifts you can pass forward. Now here is a detail that can make or break the entire strategy. When you do a Roth conversion, you owe income taxes on the amount converted. The question is where that tax payment comes from, and it matters enormously. If you pull money from the IRA itself to cover the tax bill, you are shrinking the amount that actually lands inside the Roth. You lose the compounding benefit on every dollar used for taxes, and if you are under 59.5, that tax withholding could even trigger an early withdrawal penalty. The far better approach is to pay the conversion taxes using money from a taxable brokerage account or regular savings. This way, the full converted amount stays inside the Roth and grows completely tax-free from that point forward. Think about it this way. If you convert $50,000 and pay the taxes from outside funds, the entire $50,000 compounds tax-free for decades. That distinction alone can be worth tens of thousands of dollars over time. Now, executing this strategy correctly is not something you want to guess your way through. Roth conversions interact with multiple layers of the tax code all at once. We are talking about capital gains rates, itemized deductions, tax credits, and for early retirees, healthcare subsidies under the Affordable Care Act. If your income crosses certain thresholds, you could lose those subsidies entirely, turning what seemed like a smart conversion into a costly mistake. A poorly timed conversion, or one that is simply too large, can trigger consequences you never saw coming. That is why working with a qualified financial planner or tax advisor is not optional here, it is essential. The goal is to model out multiple scenarios before committing to a conversion amount each year. What happens if you convert $30,000 versus $50,000? How does each scenario affect your subsidies, your bracket, your future RMDs? A professional can run those numbers and help you find the sweet spot every single year. Now let's bring everything together into a clear action plan you can actually use. Step 1. Identify your retirement date and map out when Social Security and required minimum distributions will begin. This defines the boundaries of your conversion window. Step 2. Calculate your projected income during those gap years. Know what your taxable income will look like so you understand exactly how much room you have in the lower brackets. Step 3. Work with a qualified financial planner or tax advisor to determine how much to convert each year without crossing into higher tax territory. This is not a one-size-fits-all number. It changes annually based on your full financial picture. Step 4, and this is critical, start as early as possible. Even 2 or 3 years of strategic conversions can dramatically reshape your tax situation in retirement. The window is real, it is limited, and the cost of waiting is measured in thousands of dollars over time. If this breakdown opened your eyes to what is possible, imagine what you could do with a full library of strategies like this delivered straight to your inbox. Subscribe now and join thousands of people who are getting ahead of retirement taxes, not scrambling to catch up. Every week you will get clear, actionable insights on Roth conversions, income planning, Social Security timing, and more, written in plain language with no jargon and no sales pitch. Just the kind of thinking that actually moves the needle. Hit the subscribe button below, enter your email, and let us help you make the most of the window while it is still open.